Welcome to Dinar Daily, the leading hub for those tracking one of the most anticipated financial events of the modern era. The idea of a substantial currency revaluation, commonly referred to as an RV, has long been associated with the Iraqi Dinar, or IQD, for years. The Iraqi Dinar has been a focal point of intense speculation among a dedicated community of international observers and currency enthusiasts. This focus is often twinned with similar discussions concerning the Vietnamese Dong, VND, and, more recently, the Zimbabwe dollar, ZWL, or its various successors, suggesting a unified monetary event is on the horizon. The enduring theory revolves around the concept of these currencies being significantly undervalued relative to their nation's underlying economic potential, especially in the context of global trade and resource wealth. As we look toward October 2025, the global financial world, at least within this specific community, appears to be on edge, anticipating a potential transformation that some believe could reshape global exchange rate dynamics. Analysts and market commentators have coined dramatic terms like seismic monetary realignment to describe the possible outcome of these speculative events, theorizing a rewriting of the foundational rules governing cross-border financial valuation and commerce. This dramatic language reflects the high hopes placed on a sudden, major shift in the nominal exchange rates of these currencies, while online discussion boards and social media have been rife with unverified rumors for over a decade. The narrative now circulating suggests something fundamentally different is taking place. Proponents of the revaluation idea point to what they perceive as a growing wave of synchronized signals, consistent informational leaks, and systematic institutional adjustments that appear too harmonious to be dismissed as mere random speculation. The belief is that these indicators, when pieced together, form a coherent picture of preparatory actions within the global financial infrastructure. The atmosphere across certain financial sectors is described as escalating from mere chatter to an unmistakable hum of anticipation. This heightened sense of expectation is fueled by the idea that mounting evidence is shifting the narrative from a long-running myth to a genuine prelude to a profound global currency event. The perceived implications of this event are vast, touching upon matters of global wealth distribution, international economic power structures, and the very mechanics of the contemporary financial order. October 2025 has consequently emerged as a distinct focal point in this ongoing narrative. It is frequently described by longtime market observers and speculative investors as the critical inflection point that will finally distinguish rumor from concrete reality. This specific month has reportedly transcended fringe currency groups and is allegedly being discussed in quiet corners of global finance, where systemic, silent preparations are purportedly underway to handle the unprecedented event. A key element of the current speculation involves alleged infrastructural upgrades within the international banking community. Proponents suggest that transaction systems, including digital processing networks and international settlement protocols, have been quietly upgraded. These supposed modifications are said to be specifically designed to handle and seamlessly integrate sudden and dramatic valuation changes across the handful of currencies in question, signaling institutional readiness for a structural shift. The Iraqi dinar, despite its history of political instability, economic challenges, and current international financial restrictions, remains the leading focus of this fervent speculation. Iraq's vast oil reserves are often cited as the primary underlying asset that justifies the expectation of a significant, eventual currency strengthening. The narrative positions the IQD as a suppressed currency whose exchange rate is artificially low, waiting for the right moment to be restored to its true market value. Similarly, the Vietnamese Dong and the Zimbabwe dollar have been woven into this intricate financial conversation. Vietnam is recognized globally for its rapidly modernizing economy and massive growth as a manufacturing and export powerhouse, factors that lend credence to the idea of a stronger national currency. The Zimbabwe dollar, on the other hand, is a topic of renewed discussion following the country's introduction of a gold-linked digital currency unit, which many see as an attempt to stabilize its hyperinflation-plagued monetary history. The compelling nature of the October 2025 timeframe, according to the speculative narrative, lies not just in the ongoing rumors, but in a perceived alignment of critical global macroeconomic factors. These factors are said to include the maturation of global debt cycles, the reevaluation of current reserve currency compositions by major central banks worldwide, and the alleged quiet re-entry of new asset-backed monetary frameworks into policy discussions. This convergence of monetary pressure, market readiness, and institutional signaling is interpreted as proof that a global currency recalibration is imminent. Early reports circulating through investor channels and international policy circles have further intensified the narrative, suggesting that this revaluation window is not merely hypothetical but a documented, planned event. Sources familiar with the matter, often characterized as insiders, claim that private banking networks and vast multinational exchange systems have been running quiet simulations since the third quarter of 2024 to adjust baseline parameters for a potential sudden shift in nominal exchange rates. The speculation goes even deeper, with alleged internal communications from several Tier 1 banks, reportedly referencing event-specific liquidity protocols and restricted currency access controls. These terms are interpreted by enthusiasts as clear technical language indicating preparatory steps for controlled, phased revaluation. These claims contribute to the notion of a well-orchestrated, pre-planned sequence of events designed for an orderly transition to new currency values. While these documents or communications lack any official acknowledgement from global financial regulators or monetary authorities, the visible patterns in the financial system are interpreted by supporters as confirmation. These patterns are described as encompassing periods of restricted Forex data, temporary platform blackouts, and synchronized technical updates across multiple international trading systems, which together paint a highly suggestive, albeit unverified, picture of deep preparation. Financial experts consistently caution the public that large-scale structural financial changes almost never occur as instantaneous overnight events. Instead, they typically unfold gradually through staged, calibrated policy adjustments over extended periods. However, the synchronized timing and the allegedly closed-door nature of the current reported banking activities have led the revaluation community to conclude that the central question is no longer if, but rather when, with October 2025 singled out as the imminent date for this alleged unprecedented monetary realignment. The overall reaction across mainstream global financial markets has been described as mixed, but with an undeniable element of alert observation. Trading desks in major financial hubs like London, New York, Dubai, and Hong Kong are purportedly monitoring the specific currency pairs associated with the revaluation story with exceptional scrutiny. In addition, advanced algorithmic trading systems are reportedly being recalibrated to anticipate and manage potentially unorthodox and sudden fluctuations. Furthermore, reports suggest that various hedge funds are taking defensive positions by diversifying their capital into tangible assets such as physical gold and rare commodities. This type of strategic movement is often a standard defensive maneuver utilized when significant currency volatility is anticipated in the immediate future, which enthusiasts interpret as a further sign of a looming event. Meanwhile, retail investors who have long held IQD, VND, and ZWL are watching these developments with renewed and heightened hope. Some analysts within private equity firms have ventured to speculate that a validated revaluation event could potentially trigger a global redistribution of wealth on a scale not witnessed since the major economic restructuring that occurred at the conclusion of the Bretton Woods era. Conversely, a more cautious group of financial experts issues stern warnings about speculative overreach and the inherent dangers of relying on supposed insider knowledge within an opaque and volatile financial environment, despite the prevailing skepticism from mainstream economists. The observable market activity, ranging from reported interbank liquidity hoarding to the supposed silent tightening of currency controls, implies that major financial entities are actively positioning themselves. This positioning, whether in anticipation of a structural event or a normal market fluctuation, is seen as preparation for a change. Ultimately, October 2025 is seen as a pivotal month that will either conclusively validate decades of speculation among enthusiasts or finally lay the long-running myth of the Great Currency Reset to rest. The renewed focus on the Iraqi Dinar, Vietnamese Dong, and Zimbabwe dollar as potentially undervalued currencies is underpinned by the significant economic developments in their respective nations. Observers highlight Iraq's stable, oil-backed fiscal policy and its ongoing efforts at central bank modernization as key stabilizers. Vietnam's remarkable emergence as a top-tier manufacturing hub, attracting massive amounts of foreign direct investment (FDI), is viewed as a clear indicator of hidden currency strength waiting to be unlocked. In Zimbabwe, the recent introduction of a gold-linked digital currency unit is interpreted as a serious, albeit challenging, attempt to restore both public and international confidence in its financial system. The primary goal of these real-world reforms, according to the revaluation thesis, is to eventually lead to exchange rates that are more accurately aligned with the true purchasing power parity (PPP) of the currencies in question, thus validating the long-held expectations of revaluation. However, it is crucial to note that official data and communiques from global institutions like the International Monetary Fund (IMF) and the World Bank show no evidence of any current policy framework or scheduled mechanism for such sudden and abrupt currency adjustments. Most orthodox economists stress that currency appreciation is a gradual process, driven by consistent productivity gains, prolonged trade stability, and responsible sovereign debt reform. Not secret one-off events. Enthusiasts choose to interpret Iraq's substantial oil revenues and Vietnam's sustained export growth as unequivocal signs of their immense but suppressed financial potential. Skeptics, conversely, caution that such optimistic interpretations frequently overlook critical structural challenges, including strict liquidity controls enforced by central banks, enduring monetary policy constraints, and existing capital account restrictions that fundamentally limit the free flow of the currency. In essence, while enthusiasm remains high, any dramatic overnight revaluation remains a matter of highly optimistic interpretation rather than solid official confirmation or demonstrable financial policy. Within the various online investment forums dedicated to these currencies, discussions frequently center on alleged covert preparations by major commercial banks, including globally recognized names such as Wells Fargo, Chase, and Bank of America. These rumors claim that these institutions are setting up appointment-only exchange programs linked to specialized, higher-tier contract rates for select clients. Proponents often assert that the necessary systems are already in place to verify currency authenticity, manage client scheduling, and enforce strict identity protocols during the redemption process. The narrative surrounding these alleged banking preparations often features highly specific details, including claims of geo-fenced redemption centers, the installation of advanced counterfeit detection equipment, and the requirement for clients to sign strict non-disclosure agreements, NDAs, to participate in the supposedly lucrative specialized exchange tiers. None of these elaborate claims have ever been verified, acknowledged, or confirmed by the banks themselves or by any recognized regulatory financial authority, maintaining their status as unproven speculation. In reality, major financial institutions routinely update their security and compliance systems, including anti-money laundering (AML) and Know Your Customer (KYC) regulations, for entirely legitimate reasons unrelated to preparing for secret revaluation events. Industry experts continually advise investors to exercise extreme caution with such unverified claims, emphasizing the necessity of verifying all information directly through official banking channels and formal regulatory announcements, which represent the only reliable sources of financial information. Among the specific groups that follow the long-running currency revaluation narrative, October 2025 has been fixed upon as a symbolic and highly precise focal point for action. Online discussions and self-proclaimed insider channels circulate detailed, unverified timetables, claiming that between 8:30 a.m. and 9:15 a.m. Eastern Time on an unspecified date in October, global bank systems will simultaneously update to new foreign exchange values, thereby initiating a multi-phase revaluation rollout. According to these unconfirmed schedules, major financial centers like New York, Dallas, and Atlanta would allegedly see the initial exchanges by mid-morning, with the new, revalued rates supposedly appearing on official Bloomberg and Reuters terminals by midday. It must be noted, however, that none of these reputable financial institutions or news agencies have ever issued statements confirming any such operational plan. Both the IMF and the World Bank consistently reiterate that currency valuations are determined by broader market forces and monetary policy decisions, not by secret, coordinated activation times. Analysts who monitor these speculative markets point out that these repeating, precise date predictions tend to spike significantly during periods of broader global economic uncertainty, offering a strong sense of hope to holders of exotic currencies. While October 2025 may indeed prove to be a significant month for entirely unrelated macroeconomic reasons, such as scheduled policy reviews or energy market realignments, there is currently no reliable evidence to suggest that a coordinated global currency RV event is officially scheduled or imminent. Nevertheless, the persistence of these precise forecasts reflects the powerful hold the idea of a dramatic, once-in-a-lifetime wealth transfer moment maintains over significant segments of the retail investor world. Those who support the revaluation thesis often point to the genuine economic progress being made in Iraq, Vietnam, and Zimbabwe as irrefutable evidence that a substantial currency strengthening is not only possible, but inevitable. These positive fundamentals, they argue, must eventually lead to a structural correction in the exchange rate. Iraq, for instance, has successfully negotiated new oil production contracts and has implemented crucial transparency initiatives within its central bank framework, measures that have earned cautious but definite praise from the IMF for their overall stabilization efforts. Vietnam's economy has consistently proven to be one of Asia's most compelling manufacturing standouts, successfully attracting billions in foreign direct investment from major global technology giants like Samsung, Intel, and Apple, all while steadily modernizing its own internal banking and digital payment systems. Even Zimbabwe's decision to introduce a gold-backed currency unit is seen by enthusiasts as a key, tangible attempt to restore crucial public confidence and re-establish regional credibility, particularly through cooperation with African and BRICS-aligned partners on new monetary policy strategies. While these genuine reforms undeniably illustrate measurable growth and economic diversification, economists stress that currency appreciation is a typically gradual process that responds to sustained improvements in productivity, inflation control, and fiscal management over significant time frames, not through a sudden leap. Among the most enduring and detailed, speculative reports is the persistent claim that currency exchanges, once a revaluation begins, will occur in multiple distinct tiers. The common story outlines a three-level system. First, a public Forex rate that would be visible on all international trading platforms. Second, a standard redemption rate set slightly higher for verified currency holders with pre-scheduled appointments. And third, a top-level contract rate reserved only for meticulously vetted insider investors who sign stringent non-disclosure agreements and exchange large bundles of currency. Proponents of this tiered system argue that Such a structure is necessary to carefully control overall liquidity, effectively prevent potential fraud, and ensure a highly orderly rollout that manages the financial shockwave. In stark contrast to these claims, no banking authority or global financial regulator recognizes or employs a tiered rate system of this kind for sovereign currencies. Exchange rates are universally set by open market mechanisms, official central bank declarations, or managed flow policies, not through private, appointment-based systems designed for exclusivity. Analysts specializing in financial misinformation note that these tiered rate narratives often originate within online communities that are seeking to create and differentiate a perception of insider access from mere public participation. While these claims are highly effective at generating both excitement and a powerful sense of exclusivity within the community, experts strongly advise extreme caution. Without transparent official policy documents, confirmed regulatory filings, or verifiable bank statements, such elaborate financial frameworks must be considered entirely speculative. For any speculative investor, preparation is often the crucial element that separates those who remain financially grounded from those who become dangerously swept up in hype and emotional decisions. Financial planners consistently stress that investors should focus all their attention on verifiable actions and documentation rather than chasing rumored, firm timelines. The most common and significant missteps include the failure to perform basic due diligence, not confirming the absolute authenticity of any foreign currency purchased, lacking proper identification or transaction records, or inadvertently engaging in activities that could potentially breach international financial privacy laws. Another critical misstep often observed is underestimating the absolute necessity of developing a clear, comprehensive post-investment strategy. This critical strategy must fully address tax obligations in multiple jurisdictions, secure all necessary legal documentation, and establish robust asset protection mechanisms. To effectively mitigate all these risks, responsible wealth managers strongly advise completing what is often called a pre-investment readiness checklist. This checklist includes verifying that all currency holdings are legitimate, ensuring all personal documentation is current and compliant, and consulting with qualified legal, accounting, and tax professionals before making any major financial decisions. The reality is that even if a dramatic, sudden revaluation event never occurs, these disciplined financial habits, compliance, protection, and documentation are essential for safeguarding personal finances and demonstrate disciplined financial behavior. Preparation in this context is not about the pursuit of unverified insider information. It is about maintaining strict compliance, proactively protecting existing assets, and being fully prepared to capitalize on any legitimate opportunity that may arise as global markets evolve naturally over time. If a major financial shift, whether through investment success, inheritance, or a business windfall, were ever to occur, the primary challenge would not be the acquisition of the wealth itself, but its careful and responsible preservation. History is replete with countless examples of individuals who quickly lost their fortunes due to poor planning, emotional reactions, or dangerous overexposure to high-risk speculative ventures. Financial counselors consistently advise that anyone who experiences a sudden and large influx of wealth must first establish an unshakable, secure foundation. This secure base should include trusted, independent legal representation, verified custodial accounts, and asset protection mechanisms, such as properly structured trusts, all designed to secure the assets from immediate risk. Furthermore, diversification remains the most critical principle for preservation, spreading assets across stable, tangible holdings like real estate, precious metals, and productive investments that generate stable, long-term income, rather than relying solely on speculative gains. Equally important to the financial structures is the behavioral discipline of the individual, which involves maintaining strict discretion, respecting all necessary confidentiality agreements, and developing the sustained discipline required to manage spending and avoid sudden, extravagant changes in lifestyle. True wealth management is a multi-decade process that absolutely requires ongoing education, immense patience, and consistent professional support from a team of experts. Whether the speculative date of October 2025 ultimately brings a sudden, extraordinary financial event or simply passes as another moment of heightened anticipation, the core principle for all investors remains constant: financial preparedness and responsible, disciplined stewardship are the defining factors of lasting prosperity. The genuine end goal for any investor should not be merely sudden, immediate gain, but rather the establishment of sustainable, long-term security, a financial foundation that is robust enough to endure well beyond the lifespan of any single economic cycle or speculative rumor. Among the dedicated followers of the currency revaluation narrative, the potential global impact of a confirmed RV event has become a central point of debate, particularly concerning the future of the US dollar. Enthusiasts firmly believe that, if such an event were ever formally validated by the International Monetary Fund or the World Bank, it would immediately signal a fundamental shift toward a multipolar reserve currency environment, where the US dollar would be forced to share its long-held influence with a carefully selected basket of key emerging market currencies. However, analysts in mainstream finance consistently point out that neither the IMF nor the World Bank has provided any signal, hint, or concrete plan to endorse or coordinate a financial transformation of this dramatic, immediate nature. Yet, the persistent idea captures such attention because it undeniably mirrors broader, real-world financial trends, such as the increasing economic cooperation of the BRICS nations, the growing settlement of international energy trades in non-dollar currencies, and the clear, determined efforts by nations like Iraq and Vietnam to attract highly sustainable long-term foreign investment. The broader message remains consistent. If these emerging economies continue to successfully implement structural reforms, maintain transparent fiscal policies, diversify their exports beyond primary commodities, and strengthen their banking oversight, they will naturally see a gradual but meaningful improvement in their global credit ratings and deeper market integration. True financial progress and the strengthening of a currency come from policy stability and credible, sustainable economic growth over time, rather than a single, sudden, dramatic reset. For investors who have faithfully followed the IQD revaluation story for over a decade, 2025 often feels like a symbolic culmination point, a year saturated with massive expectation and intense speculation. Online communities characterize it as the threshold moment that will separate long-running rumor from verifiable financial reality, a potential turning point for those who have patiently maintained their currency positions. Regardless of whether such an event actually materializes, the psychological significance of this moment for the community is unquestionably real and palpable. People are actively using this moment to re-examine how they personally define opportunity, assess risk, and evaluate their long-term belief in the potential of emerging markets. The single most practical takeaway for anyone involved is strikingly clear: preparation, ongoing financial education, and responsible wealth management strategies matter significantly more than any specific, unverified rumor date. If any of these currencies were to genuinely appreciate in value, the verified data would unquestionably appear first through official channels, IMF bulletins, central bank releases, and global market terminals, and not through private leaks or secretive online communications. Until then, investors can utilize this period of heightened anticipation to proactively reassess their entire portfolio structure, strengthen their financial literacy, and develop well-rounded, diversified growth plans that are independent of speculative events. The spirit of optimism that powerfully drives these ongoing discussions is valuable, but long-term, sustainable success will ultimately depend on disciplined strategy and financial prudence, not the fleeting promise of an immediate, overnight financial reset.